while you're preserving the purchasing power of your money, your real money, which is gold, the rest is credit, you also have the upside potential of seeing that double or triple in price. When gold's at 4,800, which it will be, I won't be happy because that means the cost of a loaf of bread will be a lot higher, or the cost to rent a car or pay tuition or pay a medical bill will be grotesquely higher, whether we have a deflationary intervening period. So it's not like you're gloating when gold's at 5,000, 6,000, 10,000 or higher. That just means the purchasing power of the currency you hold is getting crushed and the world around you is struggling.
The global financial system is experiencing a fundamental transformation, with gold emerging as a central player in what experts see as an inevitable monetary restructuring. Leading analysts are now pointing out $10,000 per ounce as not just possible, but probable within this decade. Matthew Piepenburg, a macro strategist with over 20 years of market experience, views gold as a pillar of monetary stability rather than merely a hedge. He dismisses short-term speculation in favor of gold's proven long-term value preservation role. When Piepenburg discusses future prices of $4,800 to $10,000 per ounce, he frames these not as targets but as warning signals of severe fiat currency deterioration already underway. Peter Leeds, a financial analyst known for his expertise in penny stocks and macroeconomic trends, reinforces this outlook with his prediction of $10,000 gold by 2030, driven by the US dollar's systematic weakening. America's mounting debt and persistent deficits are eroding dollar confidence, while BRICS nations aggressively accumulate gold reserves, deliberately shifting away from dollar dependency. This creates dual pressure of declining dollar usage in international trade and surging gold demand from major economies. This analysis builds on gold's historical performance during periods of currency debasement. Gold's finite supply and universal acceptance have consistently enabled it to appreciate during periods of inflation, thereby preserving purchasing power as fiat currencies lose value. Recent market data confirm that this relationship remains intact, with gold appreciating to reflect declining currency values, just as it has throughout financial history. Before we begin, don't forget to like, share, comment, and subscribe. Tap the bell icon to stay updated with our latest market insights and real-time updates.
I came from Wall Street. I worked in banks. I had hedge fund experience in New York. I was a family officer in New York. I talked to hundreds of hedge funds for the last 25 years, and everyone said gold's too volatile. Gold's too volatile. And, there's a vested interest in not talking about gold. The fact is, gold's outperformed the markets. You could have started a hedge fund in 2005 and just gone long gold, taken 2 and 20 on the upside and done very well. So that the argument that gold is too volatile, which was consensus think and personal self-interest think, is just specious now. It's just proven wrong. So yeah, and in terms of pure price optionality, gold has been a fairly safe and superior investment. Now, you can pick your statistical window and show when gold wasn't, so I get that. But for 2 decades, gold has outperformed the biggest bull market in the S&P. I think that is something worth considering. And absolutely, when Egon von Greyer's, my colleague, bought gold at 300 decades ago, he wasn't looking at price optionality or I'm going to buy it at 300 and sell it 3,000. He just says, I don't trust the fiat money. I need to insure paper money. I need to understand the history of money. I need to look at the derivative market. I need to look at what the Fed and the central banks around the world are doing. I have to look at the broad money supply, how that debases currency. So he was looking at gold purely as, if I got to save in an asset, I'm going to save in something that holds its value. And so gold to him was obvious, and he was highly concentrated in gold. Of course, he bought it at 300. He bought a significant amount. He was a very successful guy, led a FTSE 100 company, made a great deal of money, and saved that money outside the banking system in physical gold because he was saving, he was preserving, he was insuring against fiat money debasement. That was an absolutely brilliant idea in terms of pure sound money, saving in gold and spending in fiat. Now, the fact that in that same period of time, gold's gone from 300 to over 3,400, of course he's happy to see the price optionality. Of course it was the right investment in terms of total and absolute return, but that was never his first thought. But to answer your question, going forward, I don't think gold's first chapter has even begun at 3,400 or 2,600 or 2,200 or 2,100. So in terms of just pure speculation, yes, gold will go higher, never in a straight line, obviously. But if that's your only play and you're looking to trade gold 3 to 6 months or 3 to 6 days, that's a very different question. And it's a very different answer. I don't know many people who've traded precious metals in the short term well. if you're holding it for the long term for the fundamental reason that it's far more valuable than whatever currency you measure your wealth in, when the world understands that, no matter what the gold price is, it holds its value more than paper money. If that's the first step, fantastic. And your investment window should be years ahead, not quarters ahead or financial cycles ahead. By the way, while you're preserving the purchasing power of your money, your real money, which is gold, the rest is credit, you also have the upside potential of seeing that double or triple in price. When gold's at 4,800, which it will be, I won't be happy because that means the cost of a loaf of bread will be a lot higher, or the cost to rent a car or pay tuition or pay a medical bill will be grotesquely higher, whether we have a deflationary intervening period. So it's not like you're gloating when gold's at 5,000, 6,000, 10,000 or higher. That just means the purchasing power of the currency you hold is getting crushed and the world around you is struggling. So it's not a gloat. But yes, you can invest in gold, whatever your age, and hold it for the long term and get not only the preservation benefit of protecting you from fiat money that's burning. It's literally like buying CDOs during the during the real estate crisis when mortgage-backed securities were dying. They were handing out insurance on that for free. You could still protect your paper wealth by buying physical gold, insure against its debasement. But you'll probably also see massive appreciation in the price of that spot price of that metal. But again, it's young people, and I understand it. They're chasing sexier tech names. They're chasing sexier trends, and they can do very well. I have talked to young men in their 20s and late 20s and early 30s who've come all the way to Switzerland who couldn't meet our minimums at Von Greyer's, who follow our thinking and have been stacking gold and silver now for 5 or 10 years. Are they making as much as they could have in Bitcoin or lost as much in Bitcoin or in NVIDIA? No. Am I proud that they're doing that? Absolutely. They're not going to be my clients. I'm very proud to see a young generation thinking 20, 30 years out. And I'm very proud that my kids are stacking gold. And I said, you buy it in your 20s so you can spend it in your 70s if you need to. But, again, it's a long-winded answer. Again, I'm not mocking speculation. I'm not mocking the desire for a 10-bagger in the equities market or in tech. I did that. I got lucky. And that was all it was. But as you get burned by subsequent bubbles or you learn the lessons of history and life, you start to think more about better safe than sorry. That's just my mentality. I would not mock, though, those that are looking for that fat pitch home run. They're just very hard to find in these markets. But I see gold as a preservation asset, to your point, but also price optionality is embedded into this market because gold is not just a hedge against inflation or insurance against fiat money. If you look at the direction of gold, the central bank purchasing of gold, the outflows out of COMEX, the BIS classification of a tier 1 asset, the net settling of most global trades in the BRICS in gold, not a gold-backed BRICS currency, but net settling in gold, purchasing and arbitraging oil in gold. Just look at the facts. Gold's not just a hedge or a precious metal or a monetary metal. It is becoming a cornerstone of the next 20, 30, 40 years. And whatever reset or chaos or smooth solution comes, the IMF to the BIS to JP Morgan recognize that gold is going to become central. And it doesn't have to be a gold-backed dollar or a gold-backed yuan or a gold-backed ruble. It could be, but more importantly, gold will become far more important once it's revalued as a way to net settle trades, as a way to purchase energy outside of the petrodollar, as a way to avoid a large monopoly of the control in the SWIFT system or the U.S. dollar reserve system. It's coming. It's already happening. It's happening right in front of us. Again, you can see the soldiers lining up on both sides of the border. You can see that gold is not just an appreciating asset or an alternative to hedge against inflation. It is becoming a cornerstone of the new financial system, which is merging from the BRICS and even in the West now.
Global central banks are executing what Matthew Piepenburg describes as a military buildup at a border, systematically preparing for a fundamental shift away from dollar dominance through unprecedented gold accumulation and the dumping of treasuries. Central bank gold purchases have more than doubled from historical norms, exceeding 1,000 metric tons annually for 3 consecutive years, compared to the average of 400 to 500 tons in the previous decade. This acceleration deceleration coincides with active efforts to establish trade arrangements outside the dollar system, signaling coordinated preparation for monetary transition. Gold's performance reflects this institutional shift, rising 26% in dollar terms during the first half of 2025 and achieving double-digit gains across multiple currencies. The combination of dollar weakness, stable interest rates, and mounting geoeconomic uncertainty has generated exceptional investment demand from both institutional and retail sectors. Current 2026 price forecasts average $3,517.85, just above existing highs, but upper estimates near $4,000 per ounce gain credibility as past projections have consistently underestimated actual performance. The sustained upward pressure reflects structural changes in global monetary policy rather than speculative demand. Let's get back to the interview.
The US dollar is fading, not overnight, but slowly but surely, and we're seeing that in the de-dollarization. We're seeing that in the rise of the BRICS. We're seeing that in gold as a tier one asset. We're seeing that movement not to end the dollar, but to reprice the dollar, and not to make gold just another asset class, but a core component of the next currency system, whatever that is, and the next reset to come, whenever that comes. They're already loading, and to use that military analogy again, you don't have to be a military genius when you see, as I've said many times, horses and cavalry and soldiers and infantry marching towards a border that the other side of that border has to prepare. They have to think, okay, something's coming. What we've seen monetarily and financially in the last 10 years, and certainly in terms of U.S. Treasuries being dumped and gold being purchased by central banks, the slow de-dollarization, not the end of the dollar, the rise of gold as a tier one status. All of these things are a way of looking at how central banks around the world are loading up on gold, dumping U.S. debt, finding new trade arrangements outside of the U.S. dollar. Again, not replacing the dollar, not ending the FX power of the dollar, but we're seeing in slow motion a frog boil of the world on the other side of that border preparing for what's coming. And they're preparing for a major currency and a major financial and a major market dislocation, and they're loading up on gold. They're dumping U.S. Treasuries. They're dumping sovereign bonds in general because they see that credit risk. And they're even loading their guns, again, literally. But change is happening. Change usually doesn't come in a kumbaya, warm and fuzzy, let's all cooperate, John Nash kind of way. It usually comes with a lot of resistance, a lot of personal power held by a very small minority, whether it's Davos or DC, whether it's the top 10% of the US, whether it's the RNC or the DNC in our politics. It's further and further far from the plow of our democratic ideals. We've lost pretty much all 10 of our Bill of Rights, except for the Second Amendment, through the slow drip of things like the Patriot Act or the constitutional death of sound money. These are just facts. You can look at them however you want, but we're less and less of what we are in the name of keeping power. And I think that's very apparent to those inside or outside of the markets. But in the financial world that I look at, it still leads to uh-oh ahead. And not just in some predictive way. We're already seeing the uh-oh right now. It's all around us. And you don't have to wait for a market crash, and we can definitely talk about markets. They will crash. No one knows when, and no one. I can tell you the things I'm tracking and the things I'm measuring, but it will happen. And the only way it doesn't is we literally nationalize the markets and monetize the markets at the expense of the currency. So there is no easy way out. There is no good scenario. Again, very bearish. It doesn't mean the end of the world or the end of your ability to invest. You just have to invest differently, more carefully, more realistically. And that doesn't just mean precious metals, by the way. But you've got to be informed. You don't have to think the way I think or many others like me think, but you have to think. If you're going to your registered investment advisor or your consensus think banker, you're not going to get these other viewpoints. You're not going to get the risk management. Risk managers in Wall Street are just long only directional traders. And whenever there's a crisis, they blame it on an extraneous event or a black swan, when in fact these black swans the gray swans are very visible. And I'd rather be years ahead than even seconds too late in preparing for these market dislocations, these currency dislocations that are literally already happening around us. So it's not even trying to predict or foresee, it's happening in real time, from recession indicators to currency indicators to market bubble indicators. And there's clearly a market bubble right now, and there's clearly market risk. And this is not just from a gold bug being perma-bearish. I've said many times I've been bullish on the short term, but the directional trend in these markets is historical. And I think they're worth talking about because they do affect us all. Even if you're not in the markets, that will affect the recession, it will affect the economy. Therefore, it affects your career, it affects your job, it affects your security. So you have to look at the dark side of the force without being permanently cynical. But the evidence is fairly overwhelming that we're in a major market dislocation period, and I think it's worth discussing even if we talk about gold and silver. And there's even talk about gold revaluation. I've written about it. These are not fantasy thoughts. They are the necessity. There has to be an asset. Even Scott Bessent said we need to remonetize certain assets. At 37 trillion in public debt, they'll probably revalue gold at some point. It'll happen overnight, like 1971 when we went off the gold standard. You can't predict it. You can't time the mentality or the secrecy or the mechanizations of a politician. But if I were a politician, at some point you can do QE through gold. You can literally revalue gold and then suddenly take down your debt to GDP from 120 to 90 to 80%. The problem is if the U.S. revalues gold to 20 or 15 or 10,000, the rest of the world does too. And countries like Russia and China have more gold than the U.S. in my opinion. I don't look at the World Gold Council. I look at the data. And so be careful what you ask for. That will help the U.S. get out of its debt to GDP crisis. But other countries that have been stacking gold far longer than the U.S. will have more leverage than the U.S. when it comes to their gold protection, their gold ownership. So it's very interesting times. I mean, I joke, but Polish housewives have more gold than the UK because Gordon Brown sold all that gold at 270 an ounce because he was a short-sighted thinker. He didn't think longer term. England's in a mess. Europe's in a mess. So a long way of saying gold is far more than just a preservation asset. It's also going to be a cornerstone of the new system. It already is a cornerstone of the new system. So I'm not even predicting. I'm not even forecasting. I'm talking about what's happening in real time. And yes, it will also rise in price, but of course never in a straight line. If you're looking to trade for the next 30 days, I can't give you any advice. If you're looking to hold for a long period, I absolutely believe in it.
Gold continues to gain momentum as global financial dynamics shift, with rising forecasts reflecting both its enduring value and growing strategic importance. As fiat currencies weaken, central bank stockpile reserves, and geopolitical tensions escalate, gold stands out as a reliable store of wealth and a critical pillar in the evolving monetary landscape. With projections edging higher and past estimates consistently surpassed, the path ahead suggests gold's role is far from finished, and its price may only be scratching the surface. Is gold on the verge of a historic breakout? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Tap the bell icon and enable notifications to stay up to date. Your support helps us to continue delivering the latest market insights to you and the broader community. Thank you for being a part of our community.